Welcome to Your Wealth by Design, a low-stress systematic approach to investing. This is my attempt to build that system. This content is for entertainment and informational purposes only. This is what works for me. It may not be appropriate for you. I am not a financial advisor, and this is not financial advice. So please do your own research before making decisions with your own money. Let's take a look at the portfolio on the day. We are down huge, 2.3% on a day when everyone is down. Big. Total World Index, Vanguard's VT, is down 1.21%. And I'm not sure how much more diversified you can get than the entire world, but it is down 1.21%. S&P down 1.24%, and the QQQ down 1.44%. So they are all basically down the same, which is interesting because the QQQ is supposed to be extremely concentrated US. S&P has basically become a proxy for the QQQ by being US equities and tech heavy. It would stand to reason that US companies that are tech companies have dominated the world index as well. Today, our increased diversification has harmed us because we have exposure to digital currencies, precious metals. We are far more diversified outside the United States. Today was a sea of red. Everything's down. Almost no safe place to hide. Utilities basically flat. The biggest loser being silver. Even though we sold, I feel like we correctly identified the trend. The trend is broken. We sold out. We went from 12% down to 3%. But even when your holding size is 3%, if the asset falls 16%, it has an outsized impact on your portfolio. The biggest losers are silver, Ethereum, gold, BTC, materials, gold, communications, consumer discretionary, technology. These three are basically tech. Communications is Meta and Google. Discretionary is Tesla, Amazon. So technology is down. International small caps are going to be a lot of mining companies, energy companies. Canada, mining, energy. US small caps, well, these are about the same. The biggest drawdowns are going to be in technology, digital currencies, and precious metals. I mean, if you look at the target allocations, we correctly identified the biggest risks and we put the smallest amount in them. Let's go ahead and move over to before we take a look at the model, let's quickly look at year to date. Year to date, we are down 4.22%. We had only just begun to dig ourselves out of this hole and we are right back in. If we compare it to the world index, wow, everything is down so much. The world index was the one to beat. It was up over 2% and now it's below 1% for the year. Everyone's giving up all their gains the whole year. Well, about a month, but still. S&P negative as much as the world index is up. S&P is down 0.83% for the year and QQQ is down 2.62% a year. If we take a look at our individual holdings, even though everything's down, energy is still up for the year, 10%. That's huge. I wish I could make 10% every month. Consumer staples is up 7%. Materials is still up 2.34%. Ex-Japan is up 2%. Europe is up 2%. A lot of these are holding on. I think it's safe to say the top half is flat to up. And they consist of low holding. So the majority of the ones that are up are in fact the ones with a trend. That is reassuring. The ones in the bottom are in fact the ones with the weakest trend. So there is rhyme to the reason. So the model is actually working. On any given day, it's really hard to predict any given day. Today is a red day. You know, one day does not make a trend. So if you zoom out a little bit and look at the actual trend, all the trends we're investing in are up. All the ones with broken trends down. Which really begs the question, am I a momentum trader buying the trend, or am I a value investor? A value investor looks for things that are extremely cheap, like cryptocurrencies right now. You're down 50%. And this was at the start of the year where it had already come down from its all-time highs. So it's down far more. Take a look at Ethereum. Pull up ETH's price. ETH is down 62%. It is currently up 5% in the last 5 years. That is wild. And it's quickly approaching its low over the last 5 years, which was, the floor is about 1,000. It's at 1,800. It's got quite a ways to go. Its most recent low was 1,600. But when it crashes hard. You had this previous level of resistance here and it had no problem crashing through that. But then that did trigger the next wave there. I wouldn't really call this on its own resistance, but yeah, I don't know how you want to look at it. Either this 1,600 is quite a bit of resistance at 1,600, or if you want to call this 1,000, the true resistance point here. But if we're in a free fall and we're trying to find what the absolute floor is, if it's any indication of how it's able to punch through its previous level of resistance, then I would imagine this 1,600 is not going to stop it. It could easily go down to 1,000 or lower, which makes me wonder why I have to decide what kind of investor I am. I don't think the model can can actually do both at the same time. Doesn't make sense. I mean, it can do both at the same time. If I was an equal weighted fund and I bought everything equally, well, then I would equally be buying everything that is down, negative trend, neutral, and positive. But I don't see the value in that, because that's a defensive mindset. Because if you were to look at, say, RSP, which is an equal weight S&P 500, over the last 5 years, you would have got a 50% return versus the actual S&P. You're looking at 75% returns over 5 years as opposed to 50. And this isn't even fully embracing momentum. This still holds everything, and there's limits and there's many restrictions, but it's more in line with momentum. When does value become momentum? The reason my portfolio does not look like this right now is because I'm holding all of these. But if I was not holding these, my portfolio would be looking better than this one. And if you look at the target weightings, I seem to be holding these by choice because I recognize that they are out of trend. And I thought that by holding them, I would be value investing. I thought I'd be able to do both. I had momentum invest and value invest. As they are out of trend, I would just dollar cost average less into them and put more into these. But I'm beginning to think it doesn't work that way, because if my model correctly identified that since the beginning of the year-to-date returns, that these were the winners, the only one out of place is this one. It's right on the cusp at 3%. Everything down here is 3% or 2%, which means that according to the model, it's forced to hold 2%. It wouldn't go lower than that. And whatever they're at is less negative than these, which are more negative. So it got a slight bump to 3. But a real trend is going to be, 4 and up, 5 and up, and that's all these. And if we just think how these trends will continue until they don't, and when they break, like silver did, I should trade out of it, which I did with silver, but I kept some. Why? Why keep any at all? I kept some on the idea that eventually it would recover, and it's easier to start from a bigger base as opposed to moving big sums of money in and out of my account with the tax implications and whatnot. Currently, the portfolio is so small that that's not a problem. But days like today are demonstrating to me the value of cash. If you realize a gain, it's not a gain until you sell. If I make money, I shouldn't really care about taxes. Why do I care if the government takes 22% of my gains when the alternative is this? A negative number is a lot less than a positive number minus 22%. These will eventually recover, right? And most people, myself included, at one point in our investing career, we have a thesis, we buy a good company, and as it moves down, we see it as a value opportunity, and we buy the dip. But you're left holding the bag, as is the case with silver. You're catching a falling knife as you DCA into the dip, and you have a sunk opportunity cost where you could be deploying this capital into a productive trend, but instead you're riding the wave down, searching for the bottom, knowing full well that trends, things that are going up tend to continue going up, as you can see, and things that are going down tend to continue going down, as you can see. What is the value in holding on to this? If I developed a model that identifies trends pretty accurately, these trends are not the trends that were established, a week ago, a month ago. These allocations look very different because all of these were the previous trend. And I rode them up until they stopped producing value, and then I rotated out of them, but I continued to hold them in small amounts, which makes no sense. So, thought experiment. If these are the new trends and these are the old, we will continue riding these until they break, in which case we capture our profits while they are still profits before they look like this. Because there's no point in holding, sure, on a long enough time horizon, 5-10 years, doesn't matter the ups and downs, you'll eventually be up more than you were. But along the way, there's sometimes huge moves, tremendous moves that make you feel good when you log in and you're up, but then they're gone. Just as quickly as you earned them, they're gone. And the whole point of investing is to actually make money. If I wanted to just hold everything, I would just choose a static strategy, whatever I feel good about. Momentum, value, equal weighted, or market cap. I would just put my money in that. I would just let it sit and I would just wait for 5-10 years. But if I'm going to be, on a daily basis monitoring my money, because I think my money is important, I'm not sure it makes sense to hold these. My model will identify when the trend switches around. And not only that, but if I get rid of half of my holdings, well, that means there's twice as much money I can put into these, which means I can actually realize more gains from the ones that are actually in trend. And what's more, as we can see in terms of performance, as you'd expect, if you hold more of the winners, you will see bigger gains. 112% returns versus the S&P's 74. There's a huge difference. And what's more is that periods of turmoil are typically short-lived, which means you shouldn't overcompensate for catastrophe, right? Because that's basically insurance. You're paying a lot of money for insurance for one day when the market crashes, which is like 1 out of every 10 years. Regardless of however much you anticipate the market to crash, whether a crash to you is 5%, 10%, 30%, 50%, the market has more green days than red days. And that's evident by the fact that over time, companies tend to make more money. So if we take a look at the total history of the S&P 500, so if you spent your life preparing for this downturn, it lasted 2 years. You would have missed out on 7 years of growth. You would have looked like a genius during these 2 years, but you'd miss out on 7 years of growth, which was a 3x on your money. You look like a genius for 2 years, and then you miss out on the next wave of growth, which is 70% in 4 years. And then you look like a genius for 2 years. Wow. 2 years and 2 years. What a coincidence. And then you would look like a fool for, what is likely the next 20 years. With that in mind, I would rather be this portfolio. And the reason I don't just use this one is because they only update their trends. They do it very slowly, which is why right now they're getting obliterated because they're locked into their trend for 6 months. But if things change, I'd like to be able to pivot pretty easily, and I think I can do that. All that said, I think we've learned something interesting. Let's take a look at the model. Okay, this looks bad. We have fear extremely high. Let's see what it numerically is at. Wow, yeah. This level of fear is equal to when the world thought Trump was going to use military to invade Greenland. So that should give you some idea of the level of fear. That's bad. The S&P 500 is below the 50-day moving average. That's typically a sign of a strong trend. To jump ahead a little bit, if we look at the S&P here, it is in a negative trend, and this divergence below the 50-day moving average is a strong indication that this trend is going to be maintained. Yeah, even according to my own metrics, on the short term, obliterated. On the medium term, not good. We are still very far from the 200-day moving average, but this is going to keep moving up. Not to spread unwarranted fear, but if things continue as they are, it's inevitable that we will cross this. We might be entering into a bear market. Fear is extremely high. Surprised our DCA is not lower. Our safety constant continues to inch higher, but there's a lot of factors that go into this, and the net result is still about $160. I'm not sure how much worse things have to get for that to change, but for now, we're at $160. So right now, we are still deploying capital at a decent rate. It's a bad day, but more bad days and to a greater degree would require a strategic shift. But right now, it's kind of a wait and see. We take a look at our trends here. Half the world is in a negative trend, but mostly 2/3 is in a positive trend. Some in a very strong trend, still healthy. Even with today's volatility, they held strong. The broken trends for today are all 3 of the major indices, which is wild. Emerging markets, we sold on that one just in time, which is good. International small caps, I think, yes, is broken. Europe is broken. I think that is US small caps. Yes, US small caps broken. So I would imagine that's due to a flight to safety, right? Small caps are very risky. When days look like today, you're not going to want to hold small caps. They're more volatile. Speaking of which, we'll take a look at the volatility in just a second. And then we've got communications technology, consumer discretionary technology, technology is broken, silver broken, BTC is broken, Ethereum is broken. If we take a look at volatility, this is the volatility of all the holdings. Anything in red is more volatile than average. Anything in green is less volatile than average. The ones making the biggest moves happen to be down. Big moves are not going up. I think I'm going to include the absolute value of the VIX. I already tracked the increasing and decreasing, but just seeing what it's actually at is also indicative. Oh, it's kind of nice that it just happens to be right there at the top of volatility too. That's fun. Let's go ahead and recalculate and see what the new allocation weightings are. Let's take a look at our trend. I'm going to move the model for a second off to the side screen so I can see both at the same time. Okay, so looking at our year-to-date performance, like we said, these are our strongest trends. Even with the update, overall, the trend is clear. The stronger trends tend to be towards the top, which is nice, not the bottom. But regardless, just keep in mind that all of these are green. I'm really tempted to acknowledge my mistake. I don't think it's possible to simultaneously be a value investor and a momentum investor, unless you acknowledge catching a falling knife does not make you a value investor. If the moment when this downtrend stops and reverses, I recognize the momentum and I buy that, well then I am buying a company that is oversold. It's cheap, it's deep value. In that moment, I would both be a momentum investor and a value investor. So then if that's the realization, which is obvious for this sort of thing, right? Why would I hold this while it lost 50%? How does that make sense? Why would I do that? It doesn't make sense. You'd wait for the turnaround and you would buy the trend. Okay, so after a lot of consideration, I think the solution is to remove the flooring mechanism that I had so that I can allow things that are negative to have zero value. Why would I want to buy a negative trend? I fully accepted the fact that I cannot simultaneously dollar cost average into negative trends and make money, which sounds so obvious. I was mistaken in my thinking that I would be value investing by buying the dip, completely missing the fact that I am catching a falling knife. I think that's the most I can do for now. I'm gonna have to keep thinking about this, but in the meantime, I think I'm going to boldly cut my losses on these negative trends. I'm going to update the portfolio according to these holdings. That in itself, I think, is a big upgrade because I've just been bleeding holding these for no good reason. This has been an extremely interesting and informative window of time in investing, but it's like I always say, the experiment continues, and I am excited and optimistic for the future. I want to thank you all for stopping by, and I will see y'all tomorrow.